Principles of Finance with Excel Modeling, copyright Lou Gaddis. Topic 7, Hedging Cash Flows with Forward and Option Contracts. In this topic, we'll talk about the essentials of forward and option contracts used to hedge cash flow risk, understand how forward and option contracts can be used to hedge cash flow, value forward contracts using the cost of carry, and using valuing options using Black-Scholes, using the IMM method or framework for risk management, identify, measure, mitigate. And this topic, we're going to continue using the Hoffman gold mine from topic 6. So let's look at this model we built in topic 6. In this model, we had a base case of most likely gold mine free cash flows, which included labor costs, the length of the season, how much pay dirt per ounce, how many days they mine, the price of gold, the appreciation of gold, working capital, CapEx, and so on. And what we did is we forecasted that they'll have net income in a base case or most likely scenario of 100,000, 102,000, with free cash flows of 48. And then we said we were going to specify the worst case and best case. So we're going to say, what if everything went wrong? You had less mining days and less gold in the ground, and gold prices went down and fuel prices went up. And then the best cases, where you had a long amount of mining days and there's lots of gold in the ground and gold prices are up and fuel prices are down and so on. So these provide maybe a range of possible net incomes and free cash flows. And then we did some hypotheticals. The problem with these best case and first case, or best case and worst case, is they're not internally consistent. Like, why would the price of oil or fuel go up and the price of gold go down? So in hypothetical, you look at different environments and say, what environments might be good or bad for my business? So I looked at a global economy booming, and I said, when a global economy booms, it's probably not going to affect, well, it definitely won't affect the amount of gold I find in the ground, but it is going to affect, say, the price of gold. And when the economy is booming, gold prices tend to go down and fuel prices tend to go up. And if there's a global bust, there's a flight to quality and gold prices tend to go up and fuel prices tend to go down because less demand from business. And then an environmental environment where you just have a very, very long winter and there's less days to mine. So we specified these, and this gives us an idea of the risk of doing business in the Yukon. Then we did some sensitivity analysis around gold appreciations and showed what happens to revenue, net income, and free cash flows as gold appreciates or depreciates. And we also did a two-factor, looking at both gold and gold ounces per ton of pay dirt, and so it's all some scenarios or sensitivity around that. And last, we did a break-even analysis. What amount of gold do we need to find in the ground to break even? And what level of gold depreciation will cause us to go negative free cash flows and so on? So these are what we call deterministic scenario analysis or risk analysis, where we're looking at specific scenarios. Then we looked at a stochastic model. In this model, we said, well, what if we assume that the mining days, the gold ounces per ton of pay dirt, the appreciation of fuel, and the appreciation of gold are random events that we're going to model using a uniform distribution, a triangular distribution, and two normal distributions. We then specified for those distributions, we specified the inputs. For uniform, we need the min and the max. Triangular, we need the min, most likely, and max. And then for normal distributions, we need the mean and standard deviations. We then generated random numbers for each one of the variables. And these are Excel's random numbers that are between 0 and 1 with a mean of 0.5. And then we gave you the formula to calculate a random, say, uniform distribution. So every time I would hit F9 and recalculate, I get a random number over here between 0 and 1, and that would translate into a random uniform distribution. And so on. So in this one here, it's between 60 and 85, and it's a uniform distribution. So every time I hit F9, you'll see a number between 60 and 85 with no central tendency. For triangular, you'll see every time I hit F9, there's going to be a number between the min and the max, but a lot of the numbers are centered around the most likely value. With the normal distribution, you'll see that the numbers the tendency is for it to be the 2% mean but based on the distribution, you'll get a bell-shaped curve of appreciations, and this formula generates that. And when I run my macro, which then effectively copies this value and puts it here, basically recalcs, gets that new value and put it here, and so on. When I run that model, I then got 10,000 possible free cash flows based on an assumption about those 4 variables and an overarching assumption that all those variables are uncorrelated. And then I looked at those outcomes, and these are the 10,000 free cash flows. Looks like most of them are between 279 and about negative 279 and 400,000, with some really high ones out here, a bunch of outcomes above 400,000. And we can talk about the average, the 5% largest, the 5% smallest, the probability cash flows are greater than or equal to 0, and so on. And this gives us an idea of the risk of operating this business, where it looks like we're going to make a little over, say, $40,000 or so on average. But you can see it could be wildly different than that. So that's how we started our analysis. Now we're going to talk about how we can change this profile using forward contracts and option contracts. So let's talk in general the risk management process. In the risk management process, a common framework is called IMM, Identify, Measure, Mitigate. So first you identify what your major risk is to your business. For a lot of businesses, it might be either cash flows or earnings. So some businesses are sensitive to what your, say, net income is going to be. All right, those are firms that probably don't worry about cash flow. They have access to capital markets, so if cash flows are negative, they can easily finance them. And other businesses, especially small businesses, worry a lot about cash flows. If they're negative and can't make payroll, that could be disruptive. So first you identify whether it's earnings or cash flow, and then you find what risks affect your business. And they could be market risks, like the prices of gold and stock prices or interest rates. It could be credit risks, like the default of a supplier. And it could be operational risks, which are any other risks, like legal or fire risk. Once you identify the risk, and identify the major risk to a gold mine would be the price of gold falling. Then you measure exposure to that risk. And that's what we did in the last topic. We measured our exposure to changes in gold and gold content in the ground and so on. And this gave us a good idea of how risky it was. And then we did some stochastic modeling to see what that distribution or risk is of the gold mine business. So we've already done the first 2 areas for IMM. And now the question is mitigation. Some risks you may choose not to hedge just because they're too small or immaterial. And that's what we probably may have found when we're talking about, well, should we hedge? If I grab over here, should we hedge the price of fuel? Well, you can see you can have an 80% appreciation of fuel and still be profitable. So maybe we don't look at fuel prices. We say, well, that's immaterial. But we will take gold and say that's the one that's really going to kill us. If we look at how it affects revenues and free cash flows, gold variability is going to affect both net income and free cash flows greatly. So what we're going to do is we're going to decide we're going to not accept gold risk, but we're going to hedge it. So what we're going to do is we could hedge it using a physical forward contract or a financial forward contract, and then we'll talk about options. A physical forward contract is just have a contract with somebody to buy all your gold at a fixed price. Therefore, you'll know exactly how much you'll be able to sell your gold for next year. So when we talk about, so that's a forward contract. So you might just have, say, a company that needs gold. Say Samsung, who makes cell phones, needs gold inside cell phones. So they might have a contract with a gold mine to buy the gold at a fixed price. And the gold mine and Samsung both mitigate their risk. The gold mine knows exactly what it'll get for the gold when it sells it. And Samsung will know exactly what it'll buy gold at. All right, but you can also buy what we call a derivative. A derivative in finance is a contract whose value is derived from something else. So I may have a derivative on gold, and we'll call that a forward contract. So let's talk about forward contracts for a minute. A forward contract is simply a contract to buy or sell an asset in the future where all the terms of the sale are known and agreed upon. So you know exactly, I'm going to sell you 100 ounces of gold in the future at a price of whatever, delivered on this date, So you know exactly what you're going to get. Say $1,200 an ounce on February 1st of next year, and I'll deliver it to your place of business. So that would be a forward contract. So when we talk about a forward contract, it's just a contract to buy or sell in the future. And all the terms are set except and including the price. And the only thing that's delayed is delivery. Now in that contract, we have two parties, that sign the contract. And we call the two parties that sign the contract the buyer and the seller. And what that means is the buyer is the person that's going to buy the commodity, in this case gold. The seller is the counterparty that's going to deliver the commodity and take the cash. All right. Now we also talk about swap contracts. Swap contracts are just bundles of forward contracts where you have multiple delivery dates, but we're not going to deal with those. And then we'll talk about options. Options are just forward contracts in which you could back out of. All right. Where forward contracts are an obligation. You can't just walk away from a forward contract without being sued. An option contract you can walk away from, but you got to pay something up front for that. So the option is a right but not obligation to buy an asset or sell an asset. So let's talk more about this forward contract. Now you can imagine a forward contract would be quite simple. You can just have a contract for a gold mine to sell all their gold to say a New York bank at a certain price. However, and say that contract is specified that to sell 100 ounces of gold at $1,200 in 1 year because the miner worries that the price of gold will fall. Now it could be a physical delivery contract. In other words, the miner gathers all their gold next year, puts it in an envelope and sends it to a bank in New York, their counterparty to this forward contract, and say that the forward price that you agreed upon is $1,200 an ounce. And you have a contract that specifies 100 ounces, so you will make $120,000. Say that New York institution will send you $120,000, and you send them 100 ounces of gold. But you can also set it as a financial settlement. So this is why it's called a forward contract sometimes, or I'm sorry, a derivative contract. You could contact that counterparty and say, you know what, let's not exchange gold. It's risky to put it in the mail, and I don't know exactly when I'll have all my gold. So let's just set up a contract. And that contract is just going to be is basically a bet on gold prices. And for the seller, that contract is going to have the following payoff. The forward price, which we agree upon, say $1,200 an ounce, minus whatever gold is selling for in the spot market next year. Now, spot market would just be the price for immediate delivery next year for gold. And you got to wait around and see what that is next year. So let's just have a contract where the gold mine will get paid, we'll have a cash flow of that forward price, $1,200, minus whatever the price turns out to be times the quantity. And what this does, it allows the gold mine to hedge gold prices without actually having to mail the gold. So let's see how that works. I already told you if they had a physical delivery contract, they would definitely make $120,000 on 100 ounces of gold. All right, because my forward price is $1,200 and I deliver 100 ounces. But what if the gold mine has this contract? If they have this contract and gold is selling, say, at $1,000 next year, gold prices fell, that's what they feared. You would make this calculation, 1,200 minus 1,000 times 100 is $20,000. You would contact your counterparty at the end of the year and say, you owe me $20,000 based on our contract. So now the gold miner now has $20,000 from an institution that it signed a contract with. And then it just goes ahead and sells its gold to their local market, which happens to be selling at $1,000. So they receive $100,000 for their gold, and they make $20,000 from the forward contract. They made $120,000. So it doesn't really matter if the contract specifies delivery or not. You could have a financial settlement. Now the payoff for the buyer is just this. You just switch the position here. The buyer in this case would lose $20,000 if it went up, because their payoff is the spot price of maturity minus the forward price times the quantity. So let's think about the worst case scenario. Gold becomes worthless. After thousands of years of old gold being valued, for some reason, next year gold prices go to zero. No one wants any. Well, the miner would just basically throw away their gold. However, they'll go to their forward contract counterparty and say, hey, you owe me $1,200 minus 0 times 100. You owe me $120,000. So you can see it doesn't really matter what happens to the price of gold at this point, because they have a contract that pays them the forward price minus the spot times the quantity. Now what we're going to do is we're going to incorporate, let's assume that Todd Hoffman and his gold mine decide that gold prices are too risky to worry about. I don't want to worry to take on that risk. So what we're going to do is we're going to assume that Todd enters into a contract to sell his expected gold, 338 ounces, at the expected spot price, say $16.32. And a financial institution agrees to enter into a forward contract that's financially settled with a forward price of $16.32 and a quantity of 338 for 1 year delivery. So I'm going to take their model and we'll just use the deterministic model. I'm going to look at these revenues here. And I'm going to just change this line. Let's pretend that in revenues we also include the effect of the forward contract. So in that case, the forward contract for Todd is $16.32 minus whatever the price turns out to be next year. We'll reference this number times 338 ounces. Well, it has no effect because $16.32 is the expected spot price. But if I copy this over, let's look what happens to this worst case. In the worst case, I had gold prices going down 40%. Notice that jumped up because in this scenario, Todd sells all his gold at $960 an ounce. However, he also gets a payoff from the forward contract. Now, the reason why it's not exactly 550 is because in this scenario, quantity of gold is also going down. He's not getting his 338 ounces, he's getting 78. But what you see is across all these scenarios, the risk is much less. So that's how we can incorporate the fact that Todd has just entered into a forward contract to sell all his gold, the expected amount, 338, at 16.32. And I can also build that into the stochastic model. So here's my stochastic model. Notice I'm going to do a few F9s here and watch what happens. Well, I can look at this one right here. So my last random outcome was gold was down 82%. And as you can guess, cash flows were terrible. But if at the beginning of the year, Todd could enter into a forward contract that has a payoff of 16.32 minus whatever gold prices are times 338, the quantity specified in the contract. Now, every time I hit F9 and gold prices are way down, Todd is getting a contract that pays him the difference between 16.32 and the spot price times 338. And if I rerun the simulation, I'm going to stop that and look at the outcomes. My payoffs, or my free cash flows, run from this very fat distribution to this thin distribution. So the range of outcomes are much smaller and the tails are much thinner. So this looks a lot less risky. However, he's given up some upside, right? There were some chances that he was going to make more than $500,000. That's all gone away, right? Because these scenarios used to be if gold price for some reason just goes way up, he'd make lots of money. But that's all gone away because if the gold prices go way up, he's going to have to pay off that forward contract. So let's talk about a put option. All right, let's talk about options in general. An option is basically just a forward contract that you can walk away from. A call option is an option to buy an asset at agreed upon price, but you can walk away. A put option is an option to sell an asset at an agreed upon price, but you can walk away. And for that right to walk away, you're going to have to pay a fee, or sometimes called a premium, to have that contract. You're going to have to pay your counterparty for the ability to walk away. Now, both parties can't walk away. So for a call option, that's an option to buy an asset where the owner of that option will pay a premium up front but could walk away. And so for a put, it's the right to, but not obligation, to sell an asset. Now let's look at a put option. If Todd decides he wants a put option, that's an option to sell all his gold at a strike price or an exercise price. So when we talk about options, we don't talk about forward prices anymore. We call it the exercise or strike price of the contract. So if Todd enters into a 1-year put option contract to sell, has the right but not obligation to sell all his gold at 1632 if he wants, but he can always walk away. And that counterparty says, I'll do that contract, but I want to charge you $222.09 per ounce of gold. Well, that means Todd will pay at the beginning of the year $773,735 for that contract. And then if the price of gold is below 1632, right, the gold prices fall below that strike, Todd will exercise the put, sell all his gold to the counterparty, and get 1632. If the gold price goes above 1632, say gold's selling for $1,800, Todd will just consider this a fixed cost or a sunk cost, and he'll just sell his gold in the spot market at, say, $1,800. Now, how we model a put option in Excel is if the price of gold goes down, I will make the difference between that exercise or strike price and the spot times the quantity. So this looks a lot like the forward payoff. However, if that number is negative, in other words, if you do the calculation and you're better off not using the forward price or the strike price, it'll give you 0. So this little function, max of 0, comma, the strike minus spot times quantity, and it models the fact that if it is not beneficial to sell the gold using the option contract, the payoff is 0. Now for a call contract, we can just swap these two and say it's the max of the spot minus the strike. However, we always have to remember to capture the option cost. So let's go ahead and put that in Todd's model. So in this case, Todd is going to pay up front. So let's put it right in here. We're up front 222.09 times 338 ounces. So Todd's going to pay $73,000 for that option. That's a sunk cost. That does not vary. However, now he has a contract that gives him either the maximum of 0 or 1632, the strike price, minus whatever the price turns out to be next year. So now this is modeling the fact that Todd now owns a put contract that he paid for. And what happens is if gold falls, so let me get a random outcome where gold prices are falling. So now we have a price of gold saying going down 24%. What happens is Todd is still doing okay because he's able to sell his gold at 1632, at least 338 ounces of it. Now he's not completely whole, right, because there are other factors going on here. Looks like he had a little less gold per ounce and didn't mine as much, right? He only mined 283 ounces, but he's doing much better than if he didn't have the contract. And then we could just run our simulation, get our 10,000 outcomes. And now I can look at the forward versus the put. Now what you see is the left side looks about the same. However, he did lose that 77,000, but he gets the benefit of the upside. Notice there's still some outcomes where he's making more than $400,000. That's because when gold prices boom, that max 0 or the payoff, the 0 is implemented. So in other words, the contract is not executed, and Todd gets to sell his gold at that really high price. So this is how forwards and options can be used to change the payoff of a contract. Now here's a technical note on the pricing of a forward contract. Forward contracts in theory should represent the current spot price times 1 plus the risk-free rate of return, that's accounting for the time value of money, any storage costs to store a commodity over that time, and minus any other benefits of actually having the asset on hand, called a convenience yield, times T. So assuming gold has no convenience component or storage cost to it, and the interest rate is 2%, we can say that the forward price of gold is 1632, the theoretical forward price. And a note on pricing options. Black-Scholes is a model. So if I take my BS call and BS put these into my Excel file under a module, and then put in parameters for gold. Say the current spot price of gold, is this S variable, is 1600. We're looking at a 1632 strike. Matures in 1 year. The annualized volatility of gold appreciations or returns is 35%. The risk-free rate is 2%, accounting for the time value of money. And since this is a model that was built for stocks, we're going to put 0 as the dividend yield. This BS put spits out a model that in theory, this should be selling for $222.09 an ounce, and that's where I got that value. So here's our final model. In this model, we talked about how we can change our payoff function, our cash flow distribution here by using forward and option contracts.